We stay with Kenya, an interesting company that we'll talk in a moment about it, but let's look overall at the markets in Africa, and we start with East Africa. The NSE 20, that's the main benchmark index in Nairobi, 25.56 points down, now at 4,994, so just under 5,000 there. And then the shilling, we've got a chart there for the shilling, and looking at it there, 83.8, and really has been steady, and that's been the characteristic of the shilling really since that election, and before the election more unstable and more central bank intervention that we've become accustomed to. But let's now go to the Kenyan market update with Einstein Kihanda, who's Chief Investment Officer at ICEA Asset Management. Good morning. Let's talk firstly about the overall performance on the stock exchange, Einstein, and essentially a steady after profit taking. Would that be a good summary?
Yes, since the developments that we saw with the stability arising from the conclusion of the election, we've actually seen a lot of profit taking. I think yesterday's was also characterized by the fact that one of the key stocks, that's Nation Media, started trading ex-bonus, ex-dividend, and that therefore resulted in the share price dropping by around 18%. But overall, you'd say there's been quite some element of profit taking as the market watchers try and see what will be the next level, in terms of the market movement.
I suppose also another measure of that is the volumes traded, and it's interesting that turnover was down to half on yesterday compared to Friday, so volumes low as well.
Yes, the volumes have also been low. I think one of the noticeable features yesterday was also the level of foreign participation. I think it was around 30%, and that is also an indication that most of the foreign activity has also dropped quite significantly when you compare to the participation that we've seen much earlier on in the year. So it will also indicate that a lot of also the foreign holders are also holding on to their stock, and probably we expect later on that we're likely to see local institutional investors actually actively participating in the market.
Well, an interesting macro number that came is that domestic debt in Kenya has touched the trillion shilling mark, and now there's concern that as this public debt gets bigger, that constrains the government. It's a new government, it wants to do things. You're also going to have costs in the devolution under the new constitution, so there are going to be bureaucratic costs there and perhaps start-up costs as new structures are put in place, but not much room to move fiscally, and that debt is concerning, isn't it?
Yes, it is a concern. I think the key, one of the reasons why we are at where we are now is actually as a result of the very heavy investment in infrastructure that has taken place over the last 10 years or so, and that had to be financed through a huge debt commitment. And of course, the other element is the fact that we've also had a lot of investment in other aspects as the government tried to improve the services to the general population. And I think as we see the devolution taking place, that is definitely going to be a challenge, and it's going to require huge commitments. We've already seen that the interest payments are also quite significant. So we've seen in 2011 very high levels of interest rates, which forced the government to have to borrow at fairly high rates. So it also presents a challenge to the incoming government as to how they're going to balance between the commitments and promises that were made, as well as the fact that constitutionally there has to be the need to finance the devolved government. So I would say quite correctly that it presents a challenge for the new government in terms of how it's going to meet those obligations.
Of course, there would be a temptation to print money to do that, and that runs the risk of inflation. And also tax revenues squeezing from the other side. Tax revenues are down because of lower economic activity.
Yes, for the last for the data for the last 6 months also actually quite indicates that the Revenue Authority has not been able to meet its targets. There has been a pending bill that would have eliminated a lot of the exemptions on VAT that is pending before the Parliament, and that would have probably resulted in revenue increasing probably by about 11 billion shillings or so. So that would have helped. Of course, the challenge for that is that the implications of that is that we're likely to see quite a number of prices going up for some of the commodities that have previously been exempted from tax. But that is one of the measures that the government can take in order to try and bridge the financing gap that is currently quite glaring.
Well, let's look at a couple of the sectors in that context. The banking sector, most of the counters losing there. The banking sector has been quite active recently.
Yes, the banking sector has, if you look at the last 3 months, of course, because of the financial results reported towards the end of mid-February, a lot of activity as a result of the market absorbing the financials. Most of the banks reported fairly strong earnings, and the share prices have therefore correspondingly also, been on the uptick. I think what we've seen quite recently is the issue of, some of the investors taking profits. And also, the key concern again is whether the stellar performance that we saw in 2012 is going to be replicated in 2013. And the biggest issue is about the interest margins. The margin between what the banks lend and what they pay depositors, and that hasn't changed significantly as yet. And we are still in the first half of the year, but I think that's a big issue that's going to determine how the banks will perform in the rest of the year.
Well, just looking at some of those banks that have been flashing on the screen while you've been talking, Einstein, a couple of them big increases over the month, so that would back what you're saying about a correction there, both over the month and from the year. And then the retail sector, Uchumi, we had a little interview just before you came on about Uchumi, and that interesting company, which actually had to close at one stage because it was insolvent. Now expanding, is this a value proposition for investors?
Yes, I think when you look at where Uchumi has come from, yes, it was insolvent for a period of time and had been suspended from trading, largely because of very heavy investment in in real estate and property, and has therefore had to go through a fairly challenging period where it had to call in, had to negotiate with suppliers and some of the shareholders, and had to also negotiate with some of the banks that the bank had that had financed the operation. And I think what we've seen is a gradual recovery to the fact that it's one of the top performing shares last year. I think the interest has also been because it's actually the only retail listed company involved in the retail sector, and that therefore for investors who are seeking to get opportunities in the retail sector, that provides probably the only opportunity. And it's also quite reflecting of the fact that the trend we are seeing in urbanization is cutting across the region, and therefore the demand for large supermarkets has continued to grow. So I think it's a question. It's an issue of opportunities being availed for investors to participate in the retail sector.